Hey folks, I'm Clayton Collins, CEO of HW Media and your host for the Housing News Podcast. Our guest today is Tom Davis, the Chief Sales Officer of Deephaven Mortgage. Tom spends his time working very closely with wholesale and correspondent sales leaders, as well as working really closely with clients of Deephaven, which we really dig into today and understand how he and his team work directly with originators across the country. In this episode, we talk about the housing market, inventory and inflation, a brief conversation about the health of the U.S. banking system, and we don't bore you too much with talk about Silicon Valley Bank. We talk about non-QM dynamics, what Tom and the Deephaven team learned from the capital markets disruption that we saw at several points over the last 3 years, and what his institution has done to repair and improve the organization to be more successful in future environments. Tom also shares his month over month and period over period lock metrics. Listen really closely. There's some big successes happening here, and there's a lot to learn from this conversation with Tom Davis, Chief Sales Officer at Deephaven Mortgage. So when we kind of look back over the past few years, like some of the dynamics that are supportive of opportunity non-QM have existed for a bit, but like early in COVID, we saw like a massive retrenchment in non-QM. We saw some headline failures. We've also seen some folks keep their foot on the gas. So like, what are some of the market dynamics that we learned about over the last 3 years that like made non-QM or private capital in mortgage lending period, like a functional model, and has anything kind of evolved or changed as we've like navigated?
Yeah, so I think when COVID happened, right, all financial markets were impacted, not just the non-agency or non-QM or private securitization market. I mean, all financial markets, mortgage, equities, international markets, everything was disrupted. And what Deephaven did early on, right, was, and by the way, the non-agency space came back very, very quickly. And what Deephaven did was built out piping outside of the securitization market to other exits outside of the securitization, because, the securitization market, if it's wounded or suboptimal, like it's been in the last 14 months, right? Or last year in January, we stopped securitizing and we started portfolioing and working with our investors to provide a different exit outside of the securitization market, right? And so that allowed us.
So if you're not securitizing, you have to either portfolio, like you just mentioned, or whole loan sale, or like what else? What are the other pipes?
Yeah, so either you could securitize or you could aggregate and hold it on your balance sheet, or if you have the balance sheet, or you could aggregate it, or if you're working with an investor that you could portfolio it into. Our parent allows us to, we have the ability to aggregate and port certain products into the portfolio, but there's other avenues. So, we quickly realized that outside of the securitization market, if you only had one exit, then you're kind of putting yourself at risk. And we saw last year, some of our competitors, that, only relied on the securitization market, the aggregated loans, the market moved against them pretty quickly. And then they were sitting on loans that were underwater. And so, it's pretty much, impacted a lot of the folks out there that just were relying on the securitization market. So for us, once again, shout out to the capital markets team. They did a phenomenal job kind of navigating us through this market. And once again, I think, the Deephaven team, and the capital markets team has done a phenomenal job there, with navigating, the volatile market.
Tom, my events team's going to kill me, but can I live on air recruit one of your capital markets folks to join us for HousingWire Annual? We're planning a lot of capital markets and secondary content.
Yeah, we could definitely, we'll hook you up. We got a great team, and we'll definitely get someone on that panel for you.
Cool. We got 6 months out. We're October in the Austin area. It'll be a HousingWire Annual, but we definitely need to get someone on to talk about how new pipes have been built. I mean, I hate it when we have to cover the negative, brutal news in mortgage lending. And the last few years has brought a lot of it. And it's only but it's only bad when the industry doesn't learn something and doesn't like improve operations, improve tech, improve funding. It sounds like this is a scenario where Deephaven, your teams actually like saw some issues and fixed them.
Yeah, absolutely. It definitely gave us a competitive advantage the entire, let's call it, last 14 months, because we've been able to provide our clients with dependable, reliable liquidity. We have honored all our locks. We didn't pull any programs. And so, definitely gave us a competitive edge. And in fact, when we talk to a lot of our clients and prospects, they actually ask us, hey, how are you executing? And we say, look, we have the ability to securitize, but that's not our only exit. We have these other exits, and they feel comfortable that we just don't have one exit, because if that exit goes away, and we've seen it happen, it will happen again. We saw event this weekend, right? It wasn't a credit event, it was more a rate event, with that happened over the weekend. But just being able to be positioned, and look, if you're an IMB or a broker, I highly recommend that you work with an investor that has the experience, that has the track record, that has the resources that you need. Because if you have deals at the last minute, whether it's any type of deal, whether it's conventional, non-agency, Ginnie Mae, and you can't close, right? That's your reputation at risk. That's the borrower who's not going to be happy, right? So you got to make sure you're working with an investor that's going to be there for you for the long haul.
So, Tom, I know our newsrooms with James Kleiman, who leads the newsroom, and Bill Conroy, who covers a lot of the secondary market and non-QM news, are always kind of looking for the best forecasts and some of the different specialty areas of the housing market. So we always see the MBA numbers, but we don't get the chance to like zoom down into non-QM too often. And over the past few years, we've gotten some forecasts from Deephaven. We get pretty frequent forecasts from Angel Oak. How do you what's your approach to sizing up the opportunity in non-QM? Like, do you approach that from a units perspective, like a demographics perspective? Like, how do you think of the opportunity you have ahead of yourselves?
Well, we're bullish. We have some aspirational goals that are pretty large that we're working on a 3 to 5 year kind of plan, early stages of that. We think that, the agencies will continue to, retract and take a risk off approach.
Yeah.
We think self-employed, the investors, there's a huge opportunity with self-employed, and that kind of continues to grow. There's a major group out there that's underserved, right? And, we think the market's going to go 2 to 3x in the next, 3 years. Once again, 70% of the originators are not originating this product or haven't. When they become aware and they know how to originate it and they become comfortable, then you're going to see production take off. And we're seeing it right now. This month, right, will be a record lock month for us over the last 3 years, post COVID. And, we're coming off February where it's only been 19 business days, and, January, in December of last year were kind of really slow months. And so we're really seeing the velocity really pick up, and we're looking to grow. We're hiring account executives on the wholesale side and across the nation. We're adding a ton of customers. Once again, I think we've 3x'd our customer base in the last year, and our counterparty risk team is super busy. So we're busy right now, and we're just heads down, just trying to refine and improve our process, and just to provide our customers with just best-in-class service and a best-in-class kind of offering and delivery and process, for them.
Yeah, there's definitely some advantageous dynamics that we talked about. So yeah, originators focusing more on non-QM because they're looking for the volume. Like, that's a massive opportunity itself. And then look at the broader economy. The Fed has not been shy about pushing interest rates into a territory where we might have a job loss recession. And you have a job loss recession, does that push more traditional W-2 type people into self-employment, into the gig economy? One of the comments that Kurt was making last week is disenchanted W-2 employees with a couple $100K in the bank going out to become real estate investors, seeking to take control of their own wealth creation versus relying on what their parents may have relied on. So like there's some dynamics out there that can not only grow the market, so you kind of have like the growing market opportunity, but then also the market penetration opportunity of having originators who are actually paying attention.
Yep, definitely. There's a lot of different trends that we follow, and that's why we're bullish in the market. Even when COVID happened, you saw a lot more folks take on more jobs, 2-3 jobs, Uber drivers, gig economy, and that's kind of picked up. And we saw, that trend, and we expect that trend to continue.
How do you have a strategy for keeping originator attention? Like, let's say we have a scenario where we see interest rates pull back down into the fives, or maybe even the refi territory, where the conventional and conforming opportunities are abundant. How do you keep originator attention on the non-QM segment if they no longer have a hole to fill in their origination pipe?
Well, that all goes back to training, right? So if they become comfortable and they're really good at what they do, they're going to enjoy originating non-QM, and especially if the manufacturing process and the delivery process, is easy, then they'll continue to do it. There's some misconceptions out there that non-QM is hard, right? Maybe certain investors are harder to deal with. It's not their guidelines. It's hard to originate. Where for us, we're an exception-based lender. There are guidelines. Close to 30% of our loans are done by exception. We're once again maniacally focused on really creating a best-in-class experience. Meeting closing dates, on time. And so, once again, when our clients are trained, and, once again, we have like 10 to 12 modules. When they have that expertise, they just don't, forget about it and start originating other products. They continue to originate those products, and then they'll continue to originate, the normal, standard agency products. So, if it's someone that's doing these by decline, not by design, then they're going to go back, but to the agency and forget about non-QM. But we spend a lot of time with our clients to make sure that they become experts, and this is a part of their business, a major part of their business.
By design, not by decline is such a great phrase. I'm sure that's one you've used before. It's the first time I've heard it. I believe I like it. I'm gonna grab onto that one. So Tom, as we close out, it's been pretty clear to me that Deephaven has had their foot on your foot on the gas in a time when other people have been more cautious. We saw about 3 weeks ago that your company announced the addition of a new chief operating officer to the team. How are you thinking about altering the executive team and then different roles in the organization and growing certain roles strategically to kind of meet the market need and meet the education need and, potentially grow at a time when other folks in the market are retracting?
Yeah, I think, yes, our new COO, Aaron Drago, has just been a phenomenal addition, great team player, really, started day one, really digging in and, refining and improving. And, look, there's a lot of talent out there, right? Some of our friends have been impacted, unfortunately, and, we're looking to bring on talent to help us, become better. And, I think we're in a great position today, and we're working on a lot of different projects and, to help us, become, the largest non-QM investor out there and the best one to work with. So, we're super excited and bullish around, where we're at as an organization, where we're going. We have a lot of, projects that we're working on that I think are going to move the needle, and technology that we're working on. And once again, we're really bullish in the space, and exciting times ahead in the non-QM space.
Awesome, Tom. Thanks for sharing your time and expertise. Really enjoyed the conversation.
Appreciate it, Clayton. Take care.